Hi, thanks for stopping in. My name is Clint Maki, and I'm a real estate broker in the state of Michigan. I've been in real estate actually for 25 years now, so I've got a little bit of a perspective on what's going on in the marketplace right now. And today I want to share that with you with respect to some of the other topics I talk about. Usually I talk about short sale, foreclosure avoidance, loss mitigation, loan mitigation. Today we're going to talk about loan modification, and it's a completely different topic within that venue. So what we're going to talk about is loan modification and how it affects you and your credit, and should you even do a loan modification? That's the question. See, the figure that I saw the other day, an official government statistic that I saw on a website, was that 16.6%, only 16.6% of loan modifications that were applied for in the last 24 months had been approved. Now that will shock some people, but it doesn't surprise me a bit, to tell you the truth. Because here's the logic behind a loan modification. A loan modification is when they basically say, okay, we're going to reset your mortgage. We'll reset your payments, we'll do something. Rarely do they change the terms of your mortgage, the interest rate, or anything like that. Usually your payment ends up staying the same. But hardly ever do they approve someone for a loan modification. And here's the logic behind it, is that you have to be able to afford your house to be able to stay in it. And most people that lost their high-paying jobs are not getting the same job pay back, or it's costing them more to live than it was 2 years ago, as I'm sure you're well aware. Or in the meantime, when they stopped making their house payments, they had a lot more debt accumulate, and now they have to get caught up with that as well. So what they've done is, if you're 6 or 9 months behind in your payments, let's say it's 9 months, at $1,000 a payment, you got $9,000 in payments that you're behind. What a loan modification does is they say, okay, let's start over again. They tack that $9,000 to the end of your mortgage. And typically, when someone's got a mortgage that they're in trouble with, they got that mortgage in between the years of 2002 and 2008. And I'm not sure what the significance of that is, other than it's just when people were out there buying at the top of the market. So if you bought a $200,000 house and the market crashed in 2006 all the way through 2008, and it's still kind of falling right now, we lost 30 to 50%, depending on what you bought and where you are. 30 to 50% is gone from that number. So my $200,000 house, if I had bought one in that time period, would be worth around $100,000 to $125,000. Now, should you modify that loan? Only you can answer that question, because it's your money, it's your deal. So what they do is they take that $9,000, they tack it on to the end of that mortgage, and then you get to pay that money back too. And if you finance that, essentially is what they're doing. It's a great deal for your bank, because you get to pay interest on interest for 15 to 30 years on $9,000. That's $27,000 in interest that they're going to make additionally. So of course they should do a loan modification if they can. I mean, they'll get you for another $27,000, not to mention that your house is probably worth less than what you paid for it. And I hate to be the guy to bring that up again to you, but it's probably true. So if you had a $200,000 mortgage and your house is only worth about $125,000, say, you get to pay that money back. And this may be your only opportunity in the next 25 or 30 years for you to escape that negative equity trap that you're in. And what I'm talking about is a short sale. And if you don't know what a short sale is, go watch some of my other videos. I explain short sale process, why your bank wants to do a short sale, how to go about setting it up, and you can always call me about this. But loan modification is not necessarily your salvation. Unless you have a really great reason for staying in your house, other than pride or you like the neighbors or something like that, financially, you have to decide what your best move is and whether it is to your advantage to do a loan modification at a 16.6% approval rate and figure it out from there. Now, the second statistic I read that was pretty disturbing, and I saw this on a Fannie Mae website, so this is another government statistic, take it for what it's worth, 75% of the people that do loan modifications end up going into foreclosure anyway. And they knew this would happen before they started the loan modification process in the first place. What they were trying to do is trying to stave off the number of foreclosures that were coming through the pipeline at one time. So they were going to delay the number of foreclosures so they didn't have them all just choke through the marketplace and have the real estate market crash even further. Now, if you did a loan modification or you're trying to do one and you're finding it's not working out, your best solution is probably a short sale. A foreclosure will stick with you for a long, long time on your credit rating, and your mortgage company does not want to foreclose on you. They do not want to foreclose. Believe me, it's very expensive for a mortgage company to foreclose on you, and there's no benefit in anybody going through a foreclosure unnecessarily. We can sell your house for less than what you owe and work out the financial details so that your credit is saved to a lot greater degree than if you were to go through a full foreclosure. Now, if you choose a loan modification and it works for you, great. Everyone's happy for you. If you choose loan modification and it doesn't work out for you, then probably your fallback position is going to be a short sale. And that means you just get rid of it, done, go on to something else. We can help you repair your credit. We can point you in the right direction of resources that will help you heal. A foreclosure, though, will stick on your credit rating for 7 to 10 years before you're even eligible to buy another house. And I'm going to talk about that in a little bit in a different video because this one's already getting a little bit long. So the bottom line is this: you get to decide whether loan modification makes sense for you or not, or whether you might be better off just going ahead and liquidating the house, starting fresh, reset your equity at today's prices, and get started back over again like so many other people have done. My name is Clint Maki. I've been a real estate broker for 25 years in the state of Michigan. I'm here to help you if I possibly can. If you're reading this as an article, there's contact information embedded in the article. If you're watching the video, you'll see probably a capture page or something, my information posted somewhere around this video. You can reach me at this phone number. I'm going to give you my phone number. It's 616-837-7630. It doesn't matter where you're from. I'll talk to you about this and point you in the right direction of some resources. And again, my phone number is 616-837-7630. I've been a real estate broker for a long time, and I'd be glad to take your calls. Clint Maki, thanks for stopping by.